you're willing to say, let's go ahead and raise interest rates again, June, even if inflation is still a forecast and it hasn't moved higher?
That's right. As long as the inflation data are consistent with the forecast I have of moving towards 2%, that would be enough. Now, as you mentioned, we've been missing undershooting inflation for quite some time. But, in terms of and I take that seriously in terms of thinking about what's happening, but in terms of monetary policy, let's remember interest rates are still very low. I'm not talking about having one interest rate increase, in the next few months or whenever isn't making tight monetary policy. It's just stepping back a little bit from the very accommodative monetary policy. So it's not about tightening policy so much as just pulling back a little bit on the accommodation we've had in place.
Well, of course, as you know, market expectations are once again a little bit out of sync with the Fed, because right now, basically, you could say the markets are pricing in just one interest rate increase. Right. You've had people like Larry Fink from BlackRock and Jeff Goodluck from Double Line talking about just one interest rate increase this year, if that. So you said even 2 or 3 weeks ago, not 2, but even 3 rate increases are reasonable this year. What is it that you see the markets don't? What are the markets missing?
Well, first of all, the markets aren't one person. There are, millions of people involved in investing and making, forecasts and decisions around that. So there are different views. When I look at the markets, the data from the markets, what you see is a kind of a bimodal distribution. A lot of people think that the modal or the baseline case is the one that I've laid out. Unemployment continuing to come down, good job growth, 2% GDP, and inflation moving back. You see this in the survey of professional forecasters, the blue chip surveys. You see it from my own colleagues in our own dot plots in our own SEP forecasts. There is this other part of the distribution, which I think of as related to concerns about Asia, concerns about Europe and Japan, the rest of the world, that there's this downside scenario where global growth really slows, other things happen, and that's a negative shock to the U.S. So obviously that's priced into the market, the possibility of a negative scenario. That seems to get a lot of weight in investors' minds. So my view that we should be gradually raising interest rates this year is based on the notion that we follow this baseline scenario, that the data continue to come in, show the U.S. economy continues to be on the good track, and under those conditions, we should raise rates. Clearly, if the downside, risks really do happen, we see really negative effects in the U.S. economy, then we should pause and wait until it's appropriate to raise rates. So I see the markets of trying to kind of balance these 2 different scenarios and come to their best estimates of what we should do. But again, my answer to your question really is my baseline scenario, which is pretty optimistic.
So there was stay on track. If we're on track, then the June rate hike is a likelihood in your view, and certainly something you would support at the very least.
Well, so I don't want to say likelihood because we're never supposed to talk about what's going to happen at FOMC meetings or what my colleagues are going to say, and then of course we're going to get a lot of data between now and then, and we'll have good discussions. But in my view, yes, it would be appropriate given all of the things we've talked about to go on that next step. But a lot can happen between now and the middle of June.